Well, hello everyone. This is Paul Ferrarisi. I am the chairman of Founders Group located here in Houston, Texas. Welcome to our webinar on maximizing your Social Security benefits and minimizing your taxes. Many people have been educated on some of the strategies to maximize your Social Security benefits, but not on how to minimize their taxes in retirement. In fact, most advisors coach people to load up their IRAs and 401k plans for retirement, which you will see may give you a lot of money, but it will be devastating in the unnecessary taxes that you will pay at a time when you least can afford to do it. The webinar is a little over an hour long, so you can pause it or come back to it later and pick up where you left off. These strategies, which I'm going to share with you, are best for those aged 45 years old to 60. Naturally, the earlier you start implementing the strategies, the better. But this program is not for everyone. Repeat, the program is not for everyone. Each person is different, and this is not a cookie-cutter approach. I encourage you, when done, to take advantage of the special offer I'll be making to you. Also, please pass this link on to family, friends, and coworkers. I feel that the more people are educated on the subject, the better their financial lives will be. So let's get started on our workshop here. Now, what we're going to be covering is how do you maximize your Social Security income, how you can obtain up to $48,000 of additional Social Security funds free. And what I mean by free is people are leaving this on the table. Folks, I am presenting this as a married couple. Now, most of these strategies work superb for single people, and again, each strategy is different for each person, but I want you to get the concepts. So I'm presenting this as that married couple, but again, it does work for single people. What I'm also going to share with you, how do you go about so you minimize your taxes during the retirement years, and how do you increase your spendable income? We are going to be talking about the retirement years, and I do not know what the picture of retirement means to you. Maybe it's taking lots of cruises around the world. Maybe it's more green fees, spending money on green fees, or traveling to visit the grandkids, or buying more presents, or contributing more to society. I don't know. But whatever the case may be, it does you no good to have lots of money if you're paying lots in taxes. So what we're trying to do is increase your spendable income there. A little bit of history here. When did Social Security begin? The Social Security Act was signed into law August 14, 1935. Now, taxes were first collected from workers on January 1st, 1937, and the first one-time lump sum payments were made in that same month of January 1937. You see, folks, the way we're used to it, monthly payments we get from Social Security. But in the first 3 years of the development of Social Security, all one got was a lump sum if they chose to take Social Security. As noted here, actual regular monthly benefits, the way we're used to receiving a monthly check, began January 1940. So who was the first person to collect Social Security benefits? Ernest Ackerman, and you'll see a photo of him there. He was a motorman, and as the program began January 1st, 1937, in his first paycheck, he paid in 5 cents a nickel and immediately quit his job. And he received a lump sum payment, again, that's how they were paid then, of 17 cents. To refresh with you, the monthly payout program we're used to did not begin until January 1, 1940. So as you can see, he took his payments early as a lump sum, kind of what a lot of people will do before their normal retirement age. So there's a good shot of him there. So who was the first person to receive ongoing monthly payments? A gal by the name of Ida Mae Fuller, who lived in Ludlow, Vermont, and her monthly check was $22.40. She began the 1st of January 1940 when she was age 65. She lived to the ripe old age of 100. Now, she did work and contribute for the 3 years, 1937 until 1940, and her total non-monthly total of all her contributions over those 3 years was $24.75, a little over $8 a year. Now, because she did live from 65 to 100, her lifetime benefits she received were over $22,800, almost 1,000 to 1 return. And so I guess if we look at a little bit of the old network marketing ideas, the first ones to get in really get the most benefit. You can see a great little smirk on her face. That was her first check that she did receive. Maybe she knew something Social Security folks did not know. The argument against relying more on Social Security is that the program will go broke. For over 40 years, I've been a certified financial planning, coaching, and counseling people over time. And I've looked at the vast changes that have happened to Social Security. They have added taxation elements to it. They put the cost of living in, so forth and so on. And each time they've made changes, I've noticed they never did anything to any of the current beneficiaries. In fact, they went back to about age 50 before they said anybody younger than 50 will be affected by these changes. So when you hear talks of we're going to have to change the retirement age or change the benefits, what they're more talking about is people in their 20s and 30s. And I am very much convinced that Congress will not do anything to those that are approaching retirement. Again, when I mean approaching retirement, are near about age 50. For those gray panthers, as they call the senior citizens, those gray panthers, I think, would march on Washington with torches and burn down the city. So I'm very, very confident that nothing dramatic is going to happen for those over age of 50 years old. Now, what often happens is I plan to start Social Security at age 70, but first, I hear a lot of these things that come about. Too many clients that I sit with and visit with, they have not planned properly for retirement. And that's why I am advocating the earlier you begin many of the strategies we share with you, the better things will be. Now, there are some complicated terms and strategies that one must learn that I'm going to be teaching you here that are very, very important so that you can take advantage of the maximization of Social Security. Well, onward and upward that we go. As we look at many of these concepts that are in place, we're going to be talking about the ideal of file and suspend. Many of you have heard that. This was made possible because of the Senior Citizens Freedom to Work Act of 2000. I'm going to be briefly covering the file and suspend. Many people have been exposed to it, but I want to share with you, please get competent advice on how to do this so that it doesn't get messed up. Now, another thing, I highly recommend that you download this report. This was put out by the Government Accounting Office in June 2011, a fantastic report. And in the report, we're going to be covering some excerpts from it. The report is about 35 or 40 pages. And again, I highly recommend that you download it. But I want to give you a couple of brief excerpts from it, which starts bringing the point home they're trying to say here. How do I ensure my income throughout retirement? And you're going to have to make some difficult choices there. What they found in the report, financial experts recommended retirees draw down on their savings. In fact, they suggested that you convert your savings into some type of an income annuity. That is sort of like the old day pensions that will provide some basic income each and every year. They also thought of converting any of you that have one of those old defined benefit pension plans into an income annuity, also for some necessary expenses, those bills that you would normally pay. So the combination of those two would actually give you a flat, shall I call it a flat line of some basic income. The report also found that people should delay their Social Security benefits until their full retirement age or longer. Approximately 75% of all Americans take their Social Security benefits before full retirement age, and of that group, 75% of it start at age 62, which is the earliest that you can begin it, but it also robs you of some tremendous benefits. Also in the report, they said people should work past their full retirement age and continue to save. They also found most people, most retirees rely primarily on Social Security, and they pass up additional lifetime retirement income opportunities by taking monies early. In fact, by taking Social Security at age 62, it's a 33% loss of the amount of benefits that they get at the full retirement age of age 66. I think the photo at the bottom clearly demonstrates what people are actually doing here. The GAO also found as life expectancies increases, and this is a key element, the Life Insurance Institute 4 years ago changed the mortality age for people from age 105 to age 120. No. Not everybody's going to live to 120, but we see examples over and over again of people really living long. For those of you who can remember the great entertainer George Burns, he had booked the Palladium in London on his 100th year birthday to do a show then. Unfortunately, he died at age 99. Of late, in the last 2 years, many of you are familiar with the last two surviving soldiers in the U.S. from World War I died very close to each other in months, and they were age 114 and 115. And what we see happening is the risk that retirees will outlive their assets. Oh, by the way, the Insurance Institute is preparing to move the mortality age from 120 up to 135 in preparing and planning for this change that's happened in our lifespans, our health care, how we exercise, how we're watching what we're eating, we're not smoking as much or drinking as much, and we're taking care of our lifespans there. Now, some people say to me, yeah, but Paul, I'm never going to live past age 85. Being a certified financial planner, I have to ask this question, well, what happens if you do live past age 85? What is your plan? Well, I don't have a plan. Oh, are you the same type of a person that says, I don't carry a spare tire in my automobile. I'll never get a flat tire. Again, what happens if you do? The statistics they found from the GAO that was a husband and wife, both at age 65, have almost a 50% chance that one of them will live to their 90th birthday and a 20% chance that at least one of them will live to age 95. Now, people say, no, I'm not going to live that long. It won't happen. What I want to share with you here is that people are living a lot longer. This past summer, I had the pleasure of going to visit with my Aunt Rose. She lives in Cape Cod, right along the water there. She turned 100 years old. Rose is sharp as a tack, to say the least. Her entire career, she was a bridal designer and a dress designer. She still keeps herself very active. Oh, yes, her eyesight is going away a little bit, but glasses and LASIK surgery are taking care of that. In fact, here's a photo of my Aunt Rose in her beautiful home in Cape Cod. And Rose is holding up a photo of one of her thousands of designs. In fact, the Museum of Fine Arts in Boston is negotiating with Rose to take her entire collection of her designs, both the bridal ones as well as the dress designs there, and put them as a permanent display in the Museum of Fine Arts in Boston. You can see the article. You can look it up yourself in the Boston Globe. That was September 5th of this year. Great gal, my Aunt Rose. Kiplinger magazine, I think many of you are familiar here, in one of the great articles, and I've footnoted all of these things so that you can read them totally later on, in their article, Tap an IRA Early, Delay Social Security. The conventional wisdom that many people have been taught is delay tapping into your IRA till later on, claim your Social Security as soon as possible, but what they found is this shortens the life of the nest egg for people, and people are basically running out of money. What the research shows is flip the order of what's being presented. That lowers the lifetime tax bite, key element. You will end up collecting higher benefits, and it will extend the portfolio longevity. So what we're saying here is hold off on collecting your Social Security early, but Paul, what will I live on to, say, my full retirement age or age 70? Well, you're going to set up a bridge for yourself. And so live on your IRA or 401k or 403b in the early years of retirement. This will allow you to receive larger Social Security benefits, and this strategy, as you will see, as I will present to you, will reduce your taxable income needs from the IRA. And remember, smaller IRA withdrawals will lead to Social Security remaining tax-free. I'm going to show you all of this and the why and the wherefore. So Kiplinger presented here a completely opposite approach that you'll see also in the GAO report and many other reports. First entry in here. One of the software packages we use is Social Security Navigator. And I just want to give you the big picture. We're going to start this thing off. In our example, and again, we've got a husband and wife here, Fred and Tammy Jones. Fred is age 58 and Tammy is age 56. And we were working with them in preparing for their Social Security. Now, if you look in the middle at age, you'll notice full retirement age for Fred is 66 years and 2 months. You remember and recall that Social Security did change the retirement age for the baby boomers there. And his expected payout will be just short of $2,700 a month. If he takes his payment early at age 62, he takes a 25% discount. And remember, a 25% loss or discount means you need about a 33% increase to recover that. So he'd be receiving around $1,700, almost $1,800. On the other hand, and this is the beginning of what we're trying to advocate, if he waits to age 70, notice his payout will be just short of $4,000. So it is a more than doubling of what he'd get from age 62. Just stay with me on the concept. Now, what most people don't understand is there was built into the formula about an 8% increase each year in your Social Security benefits, both past your full retirement age, but also before. That is, again, a 25% discount requires a 33% increase. Well, a 33% increase over 4 years is approximately 8% per year. Now, I will also share with you the statement that you get from Social Security does not, repeat, does not put into effect in their calculation the cost of living index. And that cost of living is applied to you whether you take the benefits early or you postpone the benefits. And it is averaged somewhere around 3 to 4%. Yes, as of this recording, in the past year, it looks like coming into the next year, it'll be just short of 2%, but is average around 3 to 4%. Ladies and gentlemen, let's just use 2%. If I'm going to get an 8% increase every year plus 2% cost of living, that is a 10% increase per year. And using the rule of 72, that means at a 10% increase every 7.2 years, the amount doubles. Well, we're going at approximately 8 years, and so you can easily see the doubling. Moving down to Tammy. Tammy's 2 years younger than Fred, so her full retirement at age 66 and 6 months. Again, you see her numbers here at $2,000, early at $1,333, and again, more than a double. This is your introduction. You will be seeing more on these numbers as we go further. Well, how ordinary retirees often get blindsided by a 46 to 61% tax bracket. And that's what we're going to be explaining. People structure their retirement improperly. What I had shared with you earlier, load up my IRA there, take my Social Security early, and then when I pull out my IRA, I'll have tons of money in it. They don't understand that in calculating the formula for Social Security taxes, they could get nipped into the 46 to 61% tax bracket. It's called the tax torpedo, and I'll tell you it'll be more painful than this sucker punch that you see in the picture there. And speaking of the tax torpedoes, retirees who collect reduced Social Security benefits early often need to take some IRA money to meet their spending goals as costs go up. These retirees could be hit what's known as the tax torpedo. This occurs when IRA withdrawals trigger the taxation of Social Security benefits and push the taxpayer into a higher marginal rate. For these retirees, the tax torpedo can last a lifetime. Well, let's go back to our software and make my point here on what happens when you get blindsided by a 46% tax rate. What we're referring to here is, and you're going to learn as I go forward, once you cross the second threshold in the calculation for Social Security tax, for each additional dollar that you pull out from your IRA means that 85 cents of your Social Security now becomes taxable. So for that $1 you pull, you get tagged another 85 cents. That $1 turns into $1.85 of taxable income. So if you're in the 25% tax bracket when this happens, 25% taking of the $1.85, well, you end up paying 46 cents of tax on that $1.85, which means for the $1 you got into your hand, you're paying 46 cents in tax on it. You have now entered an effective tax rate of 46%. For those that are in a higher tax bracket, the same $1, you pulled it out past the second threshold, $1.85 is now eligible to be taxed. If you're in the 33% tax bracket, a third of 185 is 61 cents. For that $1 that you pulled out, you'll be paying 61 cents in tax. Your effective tax rate is going to be 61%. Now, let's go back just for a second here. I want to make this point here on this 46% tax rate. What I'm referring to here is, let's say you take out $10,000 from your IRA and it's over the threshold amount, and because you want to go on a cruise. If you take out $10,000, that means $8,500 of Social Security will be eligible to be taxed. So I've got $18,500 eligible to be taxed. In the 25% tax bracket means that for each dollar I'm drawing out, I'm going to pay 46 cents. Or to make these numbers more in line, you're going to be paying a hefty tax. If you're in the higher tax bracket, this $18,500 eligible to be taxed in the 33% tax bracket means that you will pay, somewhere in the vicinity of about $6,100 in tax. That is $10,000, pay $6,100 in tax. You're left with $3,900 to go on your cruise. That's a very expensive trip. Whether it's the cruise or green fees or spending on grandkids, whatever the case may be, I'm dropping the seeds and you'll pick it up more and more as we go through this. So how do we reverse the tax torpedo? I'm just using two funding sources for you. Get the concept or idea. If you have a IRA or 401k or 403b or pension money, yes, some of you have dividends you may be collecting in retirement or interest income, no matter what makes up this element, or annuities or municipal bond interest, 100% of that is counted in the calculation to figure out what your Social Security tax. Yet only 50% of the Social Security you receive will be counted in the formula to calculate the tax. Again, 100-cent dollars go in on this side, 50-cent dollars will go in on this side. So basically, if I doubled the amount that I was getting from Social Security and only half of it counts, it would equate equally with my IRA money. So there's a lot of free tax-free money that I can be getting by structuring my Social Security perfectly. Folks, again, this is for married couple. For a married couple, the first $32,000 in the calculation comes to you tax-free. Now, up to up to the first 32,000. From 32 to 44,000, the next threshold, up to 50% of the Social Security will be considered taxed, and above 44,000, up to 85% can be taxed. Money Watch, CBS Money Watch, great source. In this great article came forth, and they said, you know, you can double your Social Security benefits, the case for waiting. To see the long-time benefits of waiting, consider this example from T. Rowe Price's Senior Financial Planner. Christine wrote that a man born on January 2nd, 1948, who earns about $80,200, he can expect a check of about $21.57 a month from Social Security at his normal full retirement age of 66. But if he retires this year at age 62, he'll receive just $14.58 a month. Again, the 25% haircut. It's about a third less. Using Social Security's assumption, by waiting until age 70, his checks will start at $3,300, more than double what he'd get at age 62. And you can see that $14.58, double that, it's the $3,300 is spectacular above that amount. Continuing with the article, she writes, true, he must pass up 8 years' worth of checks. In this example, that's a total of over $149,000 in inflation-adjusted benefits from age 62 to 69. But if he starts taking benefits at age 70, the bigger checks will let him make up that $149,000 plus in a little over 6 years, or by the time he's 77 years old. From then on, he'll be ahead of the game through age 85 and longer. Well, coming back through age 85, he'll have collected $786,000, or almost $220,000 more than if he had started benefits at age 62. Postponing meant 8 years of tax-free, government-guaranteed growth. This is the point from earlier, the tax torpedo. Folks, there is a built-in 8% growth per year tax-free. You add in the average cost of living at as little as 2%. That's 10% tax-free growth. Are you getting that in your IRA, 401k, or other investments? So how do we go about reducing your taxes and at the same time increasing your spendable income? Well, let's go to our software here for a second, and let me use a simple example. This is not necessarily you, not meant to be. This is to educate you. Let's say our married couple has a total income need of about $90,000. We're calling this example 1. Traditionally, people will say, I want to take my Social Security early. I'm going to grab $45,000 between the two of us, and to make up the difference, I'm going to take $45,000 a year out of my IRA. That's the $90,000. Please don't get hung up in the details, but I want to explain very briefly how the taxation works and how these strategies will begin to work for you. So to figure out how much of my Social Security will be taxed, step number 1, 100% of the IRA monies will be considered taxable, and only 50% of what I get from my Social Security, or $22,500, will be taxable. Add up the two of them, it's known as your combined income or provisional income, mean the exact same thing. So we must follow our formula now. Take your provisional income minus the first threshold for a married couple, $32,000, means I've gone over the threshold by $35,500. We take 50% of that to be considered eligible to be taxed. That's $17,750. Next, take your provisional income or combined income minus the second threshold. Well, we're over the limit by $23,500. They only count 35% of that. That comes in $82,225. If you add up the $17,750 plus the $82,225, the total amount that will be taxable for Social Security purposes will be $25,975. What I want you to see is you receive $45,000 of Social Security, and you had a blocking mechanism, so just short of $26,000 of that is eligible to be taxed. Well, how do I figure out what my taxable income is? take the 25,975 plus 100% of the IRA 401k. For this couple, 70,975 will be eligible to be taxed. Yes, folks, this is very simplistic. I have not counted in any of the deductions that are in there. They're exemptions. Just stay with me with the concept. You'll see a key term below this, tax advantage. What do you mean by tax advantage? By taking my Social Security, only $26,000 is eligible to be taxed, so I have sheltered $19,025 from being considered from taxation. That's the key element of why we are trying to coach people to suspend taking their Social Security till later and really load up on this. Now, if you see our little pie chart, red relates to taxes, green is tax advantage, or what I'm getting tax-free, I guess is another way to say it. I have shared in the past slides, and I will continue to show you, very, very easy to double your Social Security benefits if you wait from age 62 to age 70. All we have done is add a meager 25,000, a slight difference to it, not the full doubling, to begin to teach you why these concepts are important. So if they're getting 70,000 from Social Security and their need is 90,000, you will concur, I only need about 20,000 coming in from my IRA 401k, same 90,000. Let's quickly go through the formula. Remember, 100% of the IRA 401k is taken in the calculation. Boy, I cut that right in half. Now, I only use 50% of what I receive from Social Security. 50% of 70,000 is 35. Add them all up, I get 55,000 as provisional or combined income. Please subtract the first threshold from this number. You'll see you're over the threshold by 23,000, and only 50% of that will be considered eligible to be taxed here. Take my provisional income of 55, subtract it from the second threshold. I'm about 11,000 over that threshold. 35% of that is eligible to be taxed. I've got 3850. Add that amount to the 11.5, you will see my total taxable is 35,350. Ladies and gentlemen, it's half of what your taxation would be under the traditional route by following our element. And again, it's not how much money you bring in, it's how much you have to spend. So if I'm looking at a couple here that may be in the 15% tax bracket, $35,000 of less eligible to be taxed in the 35% tax bracket is a savings of around $5,000. Again, that's more spendable income, whether it's green fees, cruises, or grandkids' presents. Whatever way you look at it, that's money in your pocket. It's not how much money you make that counts, it's how much you keep that counts. So the tax advantaging here has grown to 54,000. Of the 70,000, I'm able to get around by using this one strategies. We've got other ones because that 35,000 is still too high as far as I am concerned. I want all my clients to pay less, and I'm going to show you how you pay less, but you got to wait till near the end of the workshop here. All right. The Society of Actuaries, you can see the footnote at the bottom there. Now, actuaries do all these calculations not just for pension plans. They work in insurance companies with the annuities. They get the numbers down. Pretty much they know exactly when we're going to die or when we're going to run out of money. And in their report, this is an excerpt, in general, taking taxation into account when planning the strategy for claiming your Social Security may be a key factor in helping both single people as well as couples decide what to do. I grabbed this chart to show, looking, and this was from 2011 dollars, the most recent ones that they have on this, that if you go back to the 1960s, when somebody retired in 1960, over their working career, they paid in about 36,000 of Social Security taxes. And during their Social Security years, they could expect and did receive this amount, the purple amount in Social Security benefits, and a tiny amount in Medicare benefits. Looks like the ratio was about 8 to 1. Of taxes paid in versus the benefits I've got. As we move 20 years later into the 80s, notice the taxes for Social Security were increased tremendously and the adoption of Medicare taxes came in. We see a greater amount of Medicare benefits for those retiring in 1980, but the ratios you see has dropped to less than 3-to-1 benefits. What's one of the biggest causes, if you study this report? People taking their Social Security benefits early. In 2010, for somebody that retired in 2010, between their Social Security taxes and Medicare paid almost $700,000 in, and their expected benefits will be about $900,000. So I've got a 9-to-7 ratio. And for those, I'm going out near 20 years, a little less than 20 years from now, they will have paid in almost $1 million in total taxes. And what happens is their benefits are about $1.2 million. So what we strategize and work with people is to make these benefits greater for all of you during the time that you're withdrawing these benefits out by minimizing many of the taxes there. What we're trying to teach you here is how you're going to be trading IRA dollars for Social Security dollars. Typically, somebody at full retirement age, what do they map out a strategy for themselves? Most don't sit down with a professional advisor and carry out. And I'm asking you, have you sat down with your advisor to look out and draft in your plan what your income sources will be, what your taxes will be, and third, what your net income will be, and how long your funding sources are going to be there? For most Americans that do not plan, they run out of funding sources. I'm not saying Social Security, but run out of other funding sources 14 years after they've retired. And typically, somebody's full retirement, I'm going to take half of my money from Social Security and half from my IRA. That's kind of the picture of it. What we're trying to teach you about trading dollars here, many people start their Social Security early, and they start pulling their money out at a lower amount of income. And their strategy is, well, that'll allow my IRA or 401k to grow and grow and grow because I'm postponing taking from it. And as listed here, most people do take their Social Security at a smaller amount. This is traditional, the way people have been brainwashed. But from the GAO, Kiplinger, all the other reports I've shared with you, and all of my research I've done, you got to kind of flip these strategies. And that is, delay taking your Social Security, but you would need to tap into your IRA 401k plan early. So we're going to be using this as a bridge. From a pictorial standpoint, I'm making my Social Security benefits grow, and I'm bleeding down my IRA or 401k plan. Stop. This is a fear to people that are out there. But I want you to go back some slides ago. Remember, when you start pulling money out of Social Security and you're calculating the taxes on it, 100 cents out of every dollar as you pull out of the IRA will be taxed, whereas only 50% of my IRA is considered in the calculations. We did a few of these. So I'm trying to lower the amount that you will have in your IRA at age 70, for instance, when you must begin your required minimum distributions, and allowing this category to grow since only half of it will be considered for taxation. So which dollars are really more valuable to you? Let's look on the Social Security side. You do have to deal with the political risk. That's an emotional factor. I cannot take that away from you. I can only give you 40 years of my professional experience and watching what Congress does, that they don't so much change. They don't change it for people from about age 50 because they're too close to retirement and above. For those under age 50, yes, they will be doing some changes. Well, the Poseidon Adventure happens under Social Security, and that is what I'm referring to. Notice what I've shared with you, what Kiplinger and the other reports have shared with you. Most people typically take their Social Security early and take too little. What happens is they're turning themselves upside down, like the great movie, The Poseidon Adventure. And if you remember from the original movie, Gene Hackman was the minister in there, and in his little party, he had Shelley Winters, Ernest Borgnine was with him also. And the vast majorities, to escape out of the ship that was upside down, kept going to the bow of the ship. Hackman pleaded with them to go to the back where the propeller was, because they knew that the steel back there was thinner and there was a higher probability they could get out, or the rescuers would go there because the steel was thinner to cut through. So don't get hung up there. Another part on your Social Security: when you die, you cannot pass the monthly benefits on to your children. With your IRA and 401k, it can become terminal. And what I'm referring to there, whether you agree with our strategies or not, when you burn through your IRA monies and that is gone, then it's gone. It's terminal. As opposed to Social Security, for as long as you live, you will keep getting the checks from Social Security. Now, your IRA money, 401k, if it is left over, you can pass it on to the children. Moving along with this, keep in mind your Social Security, the first 15% of it is tax-free. Typically, you will average no less than a 2.3% cost of living adjustment, and there is a guaranteed 8% growth after full retirement age, but also, as you've seen in the calculation, it's taking place from the time you're age 62 to full retirement age. On your IRA, hate to tell you this, 100% is taxable. There is no cost of living adjustment put in there, and there is no guaranteed growth in your IRA or 401k. Going back to a simplistic number and reviewing our concept, if a person was to receive $1,000 from Social Security at full retirement age, a 25% discount would mean that you're taking $750. Here's the 25% penalty, which means I need to have a 33% gain to get even on that, which over 4 years averages out about 8% a year. And there is also built in an 8% growth factor from full retirement age to age 70. Not including the cost of living, I'm moving you from $750 to a minimum of a doubling to $1,500. When we work with our clients on these avenues, we actually take your numbers, put them in, and we can show you what your benefits will be. Now, again, you're seeing the slide that we showed earlier, and I want to re-emphasize again. We're trying to reverse the tax torpedo. Most people's strategy, and you're going to see they take a whole bunch of money out of their IRA 401k, 100 cents of every dollar goes into our calculation, and I've already taught you only 50% of your Social Security is used in the calculations. Reading below, with only 50% of the benefits included in the calculation, it may be possible to collect twice as many Social Security dollars as IRA dollars without increasing the taxation. Folks, simple. If only 50% are counted, I can take $2 here and only $1 is calculated here, whereas the $1 in full is calculated on the Social Security side. Well, many of you have been taught in some of your other programs how to take advantage of file and suspend. And so we're going to use an example, but I'm going to take it further in the remainder of this workshop on how you reduce your taxes. Let's take our example. We've got a married couple, Ken and Lois. Both are age 66 years old. Now keep in mind, few couples are identically the same age. And so when you're working with the Social Security people, I'm telling you there are thousands of permutations and combinations of what you can do because of the file and suspend. So there is no cookie cutter here. Again, this is not for everyone. So both are age 66. Now Lois wants to retire at age 66. Ken wants to keep working until he's age 70. Someone said to me, does he want to get away from the wife? No, I'm only teasing. Ken's present Social Security benefits at full retirement age of 66 would be $2,000 a month, and Lois's would be at $900. That's each one has their own Social Security. What we're presenting here is instead of Lois taking her benefits, she's entitled to claim spousal benefits, which are always 50% of what, in this case, Ken's income is. Ladies and gentlemen, please understand, I'm presenting this as if the male is earning more than the female. That's not always the case, so the positions would be reversed. That is, classically, the spouse with the lower income earning history would be considered the one taking the spousal benefits. But just go along to get the concept here. Ken would receive $2,000 a month. Lois entitled to her spousal benefits of $1,000 a month. Folks, this goes back to the days, and I remember the days when I was growing up. Typically, Dad worked and Mom stayed home. Well, although Mom was the homemaker at that case, she was entitled to receive spousal benefits, which were half of Dad's benefits, should I say, in this particular case, because Mom didn't work outside the home. Now, the only way she can do this to get the maximum benefits is that she cannot unless Ken files for his own benefits. And let's take this a little further. If Ken delays to age 70, he's going to get $26.40 per month. Let's go back here. Whoops, sorry. He was to receive $2,000 a month and Lois $900, but he's going to get $26.40 by waiting that extra 4 years. So this is what I'm making you a pictorial here. Ken and Lois go in, they sit in front of the Social Security representative. Ken says, I want to file for my Social Security benefits. He fills out the form, signs it, gives it to the agent, but before releasing his hand from the paper, he said, okay, but I also want to suspend taking my benefits. You will receive another form to suspend doing it. Lois is sitting adjacent to him and says, I don't want to claim my own benefits right now. I'm going to let those things get suspended, and I want to file for my spousal benefits of $1,000 a month. If you will remember, she was going to receive $900 a month in her own benefits, so she's got a little bit of a raise. Ladies and gentlemen, $1,000 a month from 66 to age 40, she's going to pull in an extra $48,000 that was left on the table. That's what I meant was free. People leave this on the table. That's 4 years at $12,000 per year. And by the way, these numbers do not include any cost of living adjustments. In the meantime, Lois is going to leave her $900 a month to grow and marinate and cook until age 70, so her benefits will grow from the $900 to $1,188. This is the concept of file and suspend. The potential advantage of file and suspend is available for people who have established a wide range of retirement benefits options. That's why I'm telling you, this is not for everyone. Number one, you've set aside a goodly amount of personal savings. Maybe in retirement you're going to work part-time. Maybe you have set up a good amount in your qualified plans, IRAs, 401k, pensions. Maybe you've got some annuities that are out there, 403bs, or the old defined benefit plans. Maybe you're going to do a little consulting, pick up some money in retirement that way. And the most important one, which is what we teach and train people, is tax advantage income. And this is why we like people to start earlier. The earlier that you start with the tax advantage income, the greater amount of tax-free income you can have in your retirement years. By the way, $44,000 is not the maximum provisional income that your taxes are based on. Actually, there are 3 tests that one must go through in figuring out the maximization of your taxation. Now, test number 1 is pretty simple. It says take 85% of the benefits, they're taxable. Test number 2 says, well, we take 50% of the benefits plus 85% of the amount over the second threshold. I hope you're getting confused here. And test number 3 is the one that's used most often that I have been teaching you on and will continue to teach you on. You take 50% of the amount over the first threshold plus only 35% of the amount over the second threshold. To give you an example and show you couple number 1, couple number 2, the differences of what I've tried to enlighten you on to take more from Social Security and less from the IRA. Couple number 1, they need $80,000 a year to live on in retirement. And they're going to draw $30,000 from Social Security plus $50,000 from their IRA. Now, using test number 3, first step is you got to figure out your provisional income. So I take half of my Social Security plus all of the IRA, that's $65,000. To go through test number 3, take the provisional income, less the first threshold, I've got $33,000 in excess above the first threshold, and I only count half of that, so $16,500 is eligible to be taxed. Next, take the provisional income minus the second threshold. I've got $22,000 in excess above the second threshold. We only count 35% of that, which comes out $7,350. 16,500 plus 7,350, 23,850 of my Social Security, of the 33,000 of Social Security, is eligible to be taxed. Add in all of my IRA 401k, so 73,850 of the 80,000 is going to be taxed. So we can see there's between 6,000 and 7,000 that we've sheltered using this strategy. What I want to share with you, let's go over to couple number 2. Memorize in your head or write it down, 73,850 of the 80,000. Couple number 2, they need the same 80,000. They have chosen to file and suspend, and just doubling his Social Security amount to 60,000. I only need 20,000 from my IRA. Without boring you, half of the Social Security is counted, plus all of the IRA to figure my provisional income. We go through the test 3, and test 3, take the provisional income minus the first threshold. I only count half of it, so 9,000 is taxable. Take my provisional income minus the second threshold, count only 35%. That's about 2,100. So my total of the Social Security that will be eligible to be taxed is the combination of 9 plus 21 is 11,500. Key point. Notice 11,100 of the 60,000 is eligible to go into the formula for taxation. That's a huge discount. Add in all of my IRA, 31,100 of my 80,000 is eligible to be taxed. I've got a huge shelter here with the IRA. If you remember from the previous one, it was over 73,000. So I have more than cut in half the amount eligible to be taxed just by moving with this simple strategy. And going back to our couple, remember the first couple, they took the money early, and their taxable portion was $73,850. And I started that at age 62, and only because we're short on room on this slide, I went on only to age 75. You'll notice if you add all of these up, it's over $1 million that will be eligible to be taxed. Our second couple said, we're going to file and suspend, postpone taking our Social Security until age 70. Well, and we're going to live on all the money that comes either out of our salary or pulling money, let's say, out of IRA 401k. All 80,000 will be eligible to be taxed. But once we switch in at age 70 using my file and suspend, you'll recollect from the previous slide, the taxable portion was only $31,100. When I add up all these same years, you'll notice the total that they pay in taxes is $826,600, which is basically about $200,000 less over this time period. In the 33% tax bracket will mean around $70,000 in less taxes people will pay. That's $70,000 more of spendable income for cruises, green fees, grandkids' gifts, or whatever. I want you to picture something else too. Going from age 75, let's just say for simple math, to 85, 10 more years of this will mean I'm going to have $738,000 eligible to be taxed using the traditional strategy most people feel. 10 more years of 31,000 means over those years I will have 310,000. So I've got 310,000 from 75 to 85 versus 738,000. Again, cut more than in half. My question is, when will taxes be more harmful to you? When you're age 62 or age 85? Another excerpt from the Society of Actuaries wrote, singles and couples in high tax brackets are going to get clipped, if I've just shown you here, and delaying Social Security will increase your lifetime income. And what we're talking about here is not only the benefits from Social Security, but also the benefits you can get over a longer time period here from your IRA or 401k. And in the article they wrote, if Mary uses his 401k or her IRA to bridge the gap from retirement to claiming Social Security, they'll be taxed at marginal rates there during her years. They figure from age 62 to age 70, you're going to get hit at whatever the marginal rate is. Delayed Social Security at higher amounts means you will withdraw less from your 401k in the slide that I've just shown you, which means less will be taxable. Overall, your taxes will be lower. So the slides previously that I showed you and the numbers is encapsulating what they're writing here in this report. Now let's go back to our tax torpedo. If you collect reduced Social Security early and take your IRA benefits, that's when the tax torpedo starts to hit. The IRA withdrawals trigger the taxation of Social Security and push you into a higher marginal tax rate. Now, this tax torpedo can last a lifetime. Now, you'll see a bomb coming at the ship. This is not your cruise ship. We're referring to the term a tax torpedo. Now, what I want to show you now is what happens, and you're going to vividly see what happens to the taxation when the tax torpedo kicks in. So let's take a look at the two examples. The income needs for this couple was $72,000, and the way that they structured this was taking my Social Security early, $28,000, and to make up the difference, we were going to take a larger amount out from my IRA and 401k plan. No, we're not going to go through the details of the taxation, but you'll notice I kept them identically the same on both sides. And notice that the total taxable was identical on both sides. What I want to portray with you here is once by following the traditional strategy of pulling IRA money now, or should I say pulling your Social Security early and supplementing with IRA as opposed to postponing your Social Security benefits, what happens if I choose just $1 more pulling from my IRA 401k? I want everybody to look down here at what becomes taxable. And I shared with you the tax torpedo, and here we go. For $1 more coming out of my IRA creates $1.85 that is now taxable. That's what I shared with you earlier. Once I go above the threshold, one more dollar coming from my IRA is dirty money when you really think about it, because it creates $1.85 in taxable income. And as I shared earlier with you, you will pay 46 cents on that $1.85 of taxable extra money for each dollar extra you have pulled out. That's going to be taxed in the 46% bracket. Hope I made a point here with you on this. Moving on. When we look at a glass half empty, half full, remember that 15% of more of your Social Security benefits come to you tax-free. That's the half-full benefit. But above that halfway point, by pulling IRA monies along with the Social Security, that can push you into higher and higher tax bracket. In fact, up to 85% of your Social Security monies can be taxable. Reviewing with you, 15% of the Social Security comes to you tax-free. Only 50% of your Social Security checks, the benefits you get, are added to provisional income, while 100% of your IRA 401k plan is added to the calculation. What we're trying to emphasize, grab more Social Security, less IRA money, and more important, more tax advantage income, which I'm going to be talking about. So let's find some tax efficient income for you. Tax advantage investments do not count at all in the calculations for provisional income. Tax advantage investments do not count at all in the calculations. So remember where we had left off originally when we had a couple who was earning about $90,000. That was their income needs. And originally they structured taking the money early from Social Security, and it was a lesser amount of $45 plus the IRA. Well, that gave them the $90,000. And I want you to look on the bottom or write it down. Their taxable portion was just short of $71,000. Now, in the example 2, if you remember, we said let's delay, file and suspend. We know in all cases it will more than double the amount, but I used a very conservative $25,000 increase. So combined for mom and dad here, they've got $70,000 from Social Security. They only need $20,000 from their IRA or 401k. That's the same $90,000. And what happened here? We cut their tax bill virtually in half. The taxable portion cut in half, so the taxes come in half. That is not good enough for me nor any of my clients. Would anybody be interested in maybe reducing that taxable amount from $35,000, cutting that in half? I didn't hear you. Was it yes? Okay. So we're going to take this example 2 and carry it forward. Here's example 2 with the $35,000. What our strategy now is, we've waited to age 70, filed and suspend to get the $70,000. In example 3, that's the same. But what we're going to change here is we are going to reduce the withdrawal from the IRA 401k by $10,000, so it's dropping from $20,000 to $10,000. And what we're going to add in its place is $10,000 of tax advantage income. This is money that is not counted in the calculation. Same $90,000. And what happens is, if you look on the bottom here, my taxable portion dropped from $35,000 down to $16,000 and change. Again, I have dropped the taxable portion again in half. And ladies and gentlemen, for a married couple right now, if that is it, that's the only income they've got, they're in the 10% tax bracket, not taking any exemptions, deductions whatsoever. Making this simple, they'd pay about $1,685, 10% of that amount, as opposed here paying in the 15% bracket of about $5,000. So I've dropped the taxable portion from you and the taxes from about $5,000 down to about $1,600, $1,700. That's more cruises, green fees, grandkids gift. Boring. I'm making my point to you there. Here's a summary of what I showed you. In example 1, remember they had about $70,000 of taxable income. And the advantage to you, it was sheltering plenty of the Social Security number by about $19,000. So we see our pie chart here. Example 2 dropped it in half to $35,000, a bigger advantage. Ooh, I see more green. That's the good portion for me that I'm not paying taxes on. And in the third example, I have made the majority not taxable by simply inserting tax advantage income. Oh, a question I get from people is, Paul, could I take lesser amount, maybe from my IRA, and more of the tax advantage, so I move the taxes down even further? You betcha. And that's what we work with our clients on. Now, tax advantage income, what are you talking about? Well, it's any source of income that meets these two criteria. Number 1, that income does not create any source of taxable income. And number 2, it is not used in the calculations to determine or to figure provisional income. Well, how do you structure your program to maximize your spendable income? Well, typically what people do is they take their Social Security retirement income, and the wrong source of other income, IRA, 401k, means left after-tax income. Or you could take your Social Security retirement income, and the correct source of other income gives you more after-tax income. Well, how do I do that? Take the Social Security retirement income and use tax advantage income, gives you even more after-tax income. Here's some secrets for Social Security. What's counted towards your provisional income? Again, 401k, 403b, your regular IRA withdrawals that will come from there. If you have municipal bond income is counted in the calculation. Any tax-deferred accounts, any annuities. In addition, all passive, active, and portfolio income is counted in there. Ooh, what's not counted in the provisions are Roth IRAs and all tax advantage income. Your question was, Paul, what's some tax advantage income programs? Those are Roth IRAs. That's one of them, one of many. And folks, it's too detailed and complicated and takes a lot of time to explain it, so we will explain and analyze when you visit with us which is the best tax advantage income for you. We have not just Roth IRAs, we kind of call them super duper duper Roths that are available. There are a host of other ones that are available that don't go into the calculation. Strategies: withdraw from your tax-deferred accounts before starting your Social Security. That's been the gist of this whole presentation. Use up your tax-deferred accounts before attacking your Roth accounts and the tax advantage. Let's wait those till later on because I'm filing and suspending, and that will benefit me more when I'm using tax advantage income. What you could do today is begin converting your tax-deferred accounts into Roth-type accounts, and within those, we like to put some type of guaranteed income source within the Roth that will be similar in nature. That is, it will be the same every month as what you're getting from Social Security. So if you got some security and you can plan what your income will be, and also your tax advantage accounts, you can convert these deferred accounts into these other tax advantage accounts before you retire and before starting your Social Security. In summary again with you, I'm beating the point here. 100% of your IRA, 401k, and other income is used in the calculations to figure your provisional income, where only 50% from the Social Security. I hope here after an hour of time I have educated you enough on why this will benefit. Again, it's not for everyone. And we got to sit down with you to analyze what's the best strategy for you. So what's the best efficient strategy? By all means, you want the largest part of your retirement income coming from tax advantage because it's zero taxable. You also want a large amount coming from your Social Security, not as much, because 50% of your Social Security is thrown into the calculation for taxation. And the least amount, this is the opposite of what you've always been trained. The least amount is from your IRA, 401ks, annuities, or other tax deferred, because all 100% of that is figured into the calculation. What we help people do is convert money from their IRAs, 401k plans into tax advantage investments before they begin the retirement. So we can look at large amounts of lump sums. In fact, we have strategies in which you can withdraw money from your IRA and 401k plan and legitimately, legally, no running around, pay zero income tax, that's the best amount, or pay as little as 1/2 of what you normally would pay with tax. Either way is great. We instruct people also, divert your contributions you're making to IRAs and 401ks, especially anything above a 1-to-1 contribution from your employer. You come in and visit with us, we will show you that anything less than a 1-to-1 or even right up to a 1-to-1 is kind of at a loss. And you will see you will end up paying more in taxes in your retirement years on your IRA, 401k than you're saving on taxes, even with the company match. As we go back to previous examples that I've shown you before, in example 1, and I only use from 62 to 75, just a refresher for you, you're increasing the amount of Social Security taxes by taking your money early. You can see the taxable portion was $73,850, paid in over those years over $1 million. In example 2, yes, we used our IRA, 401k, or we worked from age 62 to 69 to get our $80,000 of income, and that was all taxable, but then it dropped down to about $35,000. Again, it's about a cut in half here. And in the third example, the best one, when we introduced tax advantage investment, yes, from 62 to age 70, as we filed and suspend, we do pay higher taxes on the greater amount, but we were able to drop it down by using tax advantage investment and cut the amount of taxable amount in half again. So, folks, I see about $300,000 less in taxable income over this short time frame in a 33% tax bracket. That's $100,000 more in your pocket to enjoy your retirement years. In closing with you here, folks, these are general examples for education purposes and may not apply to you. I've said that many times. Work with a professional financial advisor along with your tax advisor. Well, here's our special offer. if you will kindly copy down this link here, here is the offer that I will make to you. When you go to this link, you will find a form. If you would like, and hear me out closely on this, we are a comprehensive financial planning firm. We are a fee advisor firm. We charge $300 an hour for our time. But I'm making you a very, very special offer. Whether you live in Houston or you live somewhere else, I can work this out with you. Get a hold of this form. And if not, I'm going to show you our phone number. If it doesn't work for you, you can't get into it, you can call our office and we will send it to you. Complete this very short form. There is not any information that's privileged. We're not asking for your Social Security number or anything of that nature. You don't know us. You haven't worked with us yet. And so there's nothing on there. It'll take you 5 to 7 minutes maximum. Really, it should only take about 3 minutes to fill it out. Send that form back to us. And what we will do is we will do a 10-page workup report for you. Then, hold on to this special offer. You can, if you're living here in the Houston area, you can come into our office, or I can do it on GoToMeeting. I live on GoToMeeting, and I will give you a 30-minute consultation, and we will go through your specific numbers that are on there. And so this offer I'm not making for that long. I don't know how long I'm going to keep that up. So I highly recommend you take advantage. It's not going to cost you anything. You're not under any pressure whatsoever. We want to make the report to give you a general overview if this strategy will work for you. It may not. You have absolutely nothing to lose. Now, here's our photo of our office building. We're, for those of you in Houston, we're located at Highway 59 and 610, right near the Galleria area. There's our address there. You can see our phone number and fax number that are on there. You also see our general email address, founders@foundersfgmci.com. You can take that report, you can scan it in, email it to us, you can fax it to us. Or if you want to, you can call to our main office line, and anyone of the team would be glad to fill in the report for you and get the report done. Now, here's the special offer. I don't know how long I'm going to leave this offer open, so I'd take advantage of it as soon as you can. And here's the trick. From when we get the report from you, we will give you up to 2 weeks to get your appointment and get into the office or set up a GoToMeeting. I'm giving you 2 weeks because I'm dealing with my normal clients along the way. So I'm carving out an hour of time for you free. That's about 30 minutes to do the report workup and meeting with you for about 30 minutes. And again, I don't know how long I'll keep this report online. May I offer to you to learn more about what we have to offer is to get to our reports that are there. We also do a number of blogs and reports that are on there that will educate you. No charge whatsoever for these things. So I highly recommend grab these links, go to these things. You can join it, learn, be educated more in the financial planning area, or by all means, please call into our office if you need more information on these links or how to get started with you. Hope this has been helpful to you. I look forward to working with you and helping you through this. And again, as I said at the beginning, pass this link on to family members and friends. Now, if you've already started your Social Security, well, the only thing I could kind of do for you is to educate you on some tax advantage strategies to put into event, but you can't file and suspend once you've already started. I think all of you know that. Hope it's been helpful. Look forward to working with you in the near future. Bye for now.